higher inflation is bad for equity markets? Is that a good generalization to make?
Yeah, right now it absolutely is, right? So, and really in all situations, because any sort of uptick in inflation makes the probabilities of the Federal Reserve cutting interest rates as much as the market is pricing in less and less likely. So, if we look at just a few months ago, it was 6 rate cuts that the market was pricing in, even though Jerome Powell was saying, "Hey guys, we're not going to start cutting till the second half of the year, and we're only going to do 3." I think if you look at the Fed funds futures tool, the watch tool, it's now down to 4 rate cuts this year. The first one starting in June now. So the markets are slowly adjusting to that reality.
Gareth Soloway is back. He is the chief market strategist at verifiedigvesting.com. First, a word from our sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. We'll be talking about all things to do with the market, starting with the economy and specific stocks that Gareth is following. And of course, Bitcoin. Welcome back, Gareth. Always good to see you. Happy middle of February.
Yeah, really amazing how fast the year is flying. And thanks for having me back, David. It's always great to talk to you.
A lot has already moved in the first 6 weeks of the year. Let's start with the economy. PPI numbers came in this morning on Friday, harder than expected. I'll just read a few paragraphs from the CNBC article. Wholesale prices moved more than expected in January, further complicating the inflation picture, according to a U.S. Department of Labor report on Friday. The Producer Price Index, a measure of prices received by producers of domestic goods and services, rose 0.3% for the month, the biggest move since August. Economists surveyed by Dow Jones have been looking for an increase of just 0.1%. So yes, did certainly beat expectations by quite a bit. The market seemed muted today, didn't move by much, but it did move a lot. Stock markets didn't move quite a bit earlier this week, Gareth, when the CPI numbers came out. So what do you think is going on with inflation? Is it coming back? Is my first question.
Yeah, so just from the past times we've talked, I've been pretty adamant saying that I do believe that we'll get down to that 3% handle, and then getting from 3 to 2 is always the toughest thing. And I continue to see the reminiscences of what happened in the 1970s. And in fact, I can show my chart right here, and we can just kind of take a look at it. But basically, what we see here is this was the 1970s, and you had that initial uptick, and then the Fed obviously kind of stepped aside, and inflation came down, and then we had another wave of inflation went higher. The same thing pulled back. We had another wave higher as well. And then finally it got back under control. And I really think that, as much as the Fed has said they don't want to repeat what Volcker did, if you look at the 10-year yield, right, the 10-year yield, the Fed funds rate's still at 5.25 to 5.5, yet interest rates on the 10-year are back to the 4-ish% level. In fact, we were below 4. So you've seen those interest rates come back down even without the Fed lowering rates. And what that does is it starts to initiate inflation again. It starts to kickstart that inflation because borrowing money is getting cheaper again. And I think you have to look at many things, right? So just a couple things I want to point out is that, you've seen the balance sheet of the Federal Reserve drop just a little bit. It was $9 trillion. It's down to $7.5 trillion. So the Fed has kind of started to contract that a little bit. But the kicker is, if you look at all these auto loans, credit card debt, U.S. public debt, they're all surging to the upside. And so that's making up tenfold the amount of the pullback in the balance sheet. And again, just to show you in comparison, this is the pullback here, right? This is where we were. We were trading around $9 trillion. They've only been able to reduce their balance sheet to about $7.5 trillion. And that's while the U.S. deficit has risen multiples of that over just the couple years, right? So again, my point being is that when it comes down to it, you're in a scenario where the Fed, yeah, they've tried to tighten, but the market has actually loosened. And then you talk about the extra money in the system from credit card debt to auto loans to the U.S. deficit. And it really hasn't been that tight. And I think that's probably why the stock market is at all-time highs as well.
Okay, so the 70s was a major period in economic history. There was a huge spike in oil prices, as you know, from the OPEC oil crisis. It's going to take a lot to bring back that era, in the sense that we're going to have a major supply crunch or some sort of major shock in the economy to bring
Right.
inflation up to those levels,
And
right? Yeah.
and to be fair, David, I don't think that's going to happen. Like I'm not
Okay.
anticipating inflation going to 10 and then to
Okay.
20%. But the kicker is this, right? Is that the Fed was banking on inflation getting to 3 and going below 3% so that
Mm.
they could stimulate and cut rates when the economy slows. If we're starting to even uptick from 3 to 4%, how does the Fed start to cut rates aggressively at that point, knowing the repercussions of cutting rates is to stimulate inflation again? And so I think that the more important thing here is just if you can't get the inflation rate in this period below 3%, and we start seeing an economy that's weakening, and by the way, Cisco laying off 4,000 people. I mean, we've seen layoffs starting to compound. We've seen the retail sales just came out a couple days ago, and those are starting to get weak. And one other chart I'd love to show you guys is the U6, right? And this is something I follow as a leading indicator. And if you take a look going back to the 2000 dot-com bubble, before the recession hit, U6, which again, for those of you that don't know out there, U6 is underemployed, right? So it's people that want full-time work, but they might only be able to find a part-time job or 2 part-time jobs. But if we look at this, prior to recessions, there's about a 12-month period where U6 begins to uptick even before the unemployment rate actually upticks. And you can see it right here in 2001 to 2002 before that recession. And you can also see it here in the 2006 to 2007 period before 2008. Now, COVID, it didn't really happen because obviously that was more of a black swan. But we are seeing, if we go right here, you can see an uptick in the U6, even though we are not seeing unemployment rates start to jump higher just yet. But again, these are warning signs to me that have me on high alert.
Right. Yeah, I think if you go back to that chart, just one remark, adding on what you're saying here, the unemployment rate has ticked up historically during a recession. It's not
Right.
before, it's not after, it's when a recession officially
The
hits,
U6 is
designated by
before.
U6 is before. Well, no, I mean a significant increase, right? It starts to tick up a little bit and then it moves up a lot during a recession. So yes,
Correct.
you're right. You're
Correct.
right. We're seeing warning signs of a recession if history indeed repeats itself. Now, I want to go back to trading CPI because earlier in the week when the CPI numbers came in at 3.1%, the median forecast I think was 2.9%. So even though 3.1 isn't like a big jump from the last month's numbers, it did beat expectations by a lot, which is why I think the stock markets fell a lot that day, right? I think it was
Right.
Tuesday. Yeah, it's Tuesday. Core CPI, consumer price index came out. And I think the like you said, the assumption here is that the Fed won't lower rates anytime soon because CPI is not moving down. So generally speaking, then would you say higher inflation is bad for equity markets? Is that a good generalization to make?
Yeah, right now it absolutely is, right? So, and really in all situations, because any sort of uptick in inflation makes the probabilities of the Federal Reserve cutting interest rates as much as the market is pricing in less and less likely. So, if we look at just a few months ago, it was 6 rate cuts that the market was pricing in, even though Jerome Powell was saying, "Hey guys, we're not going to start cutting till the second half of the year, and we're only going to do 3." I think if you look at the Fed Funds futures tool, the watch tool, it's now down to 4 rate cuts this year. This the first one starting in June now. So the markets are slowly adjusting to that reality. The interesting thing about it is the stock market's still pretty close to the all-time highs. We really haven't seen a pullback yet. And the kicker for this is simple, right? You have a market where everyone is starting to chase. This is exactly what we've seen going past to, like, you look at a scenario like what we saw in 2021, where there were a lot of bad signals out there of what was going to come in 2022, but money was just saying, I don't care about valuation. I don't care about technicals. I am just going to jump in, and it creates these bubbles. And a good example of the bubble, right? I mean, take a look at SMCI. This is one of the favorite out there of the meme crowd, right? If we look at this today, look at this. I mean, this run up was incredible, up and away. We're talking about from $300 at basically mid-January, so 1 month ago. And where are we as of this morning? We were trading at 1080 before a collapse back down. This is bubble territory. And by the way, I'll even go on record and say this is the same sort of thing. The atmosphere in the market is the same as when I called the top in Bitcoin at 69,000 in 2021. It is exactly the same psychological sentiment out there.
This is just for this one particular stock or all semiconductors?
No, it's generally most semis. I mean, obviously the leaders are, you have NVIDIA, which is one of those, and then you have other ones like SMCI and a few others. ARM is a big one as well. But we're also seeing this in other things as well. I mean, if you look at a Microsoft, I mean, Microsoft has gotten way out of control. I can bring up that chart. We can see in exactly what's going on there. But these type of moves that have just created these behemoths, well over $3 trillion valuations, they're getting extended because the money flow is focusing in on just this group. And I think it's important to remember that if you look at which sectors, there's 11 sectors in the S&P, right? There's only one sector that has been hitting new all-time highs, and that's technology. Everything else has been left by the wayside. In fact, I believe I just read earlier this week, 39% of the S&P is still below its 50 moving average, which is astounding for a market that is hitting new all-time high.
Right. I want to come back to stocks and semis in just a bit, but I'm going to close off on the Fed. Earlier, you said something really important, which is that the Fed is unlikely to cut rates if inflation is high. Yes, that's a good point, Gareth. But what if, let's say, the U6 unemployment rate that you pointed out continues to go higher? Wouldn't that incentivize them to cut? In other words, wouldn't higher unemployment numbers be actually good for stock markets because it signals that the Fed would need to start cutting?
Yeah, and that's where things get tricky. And honestly, no, that's not a good scenario for the stock market, because if you have higher inflation, but then you start seeing unemployment spike, yes, there's going to be pressure on the Fed, but the Fed has to weigh the risks of causing inflation to have another super spike by cutting too much and creating too much liquidity versus obviously having a slightly elevated unemployment rate. Like, so for instance, if you told me that we were going to have a 10% unemployment rate, heck yeah, the Fed would be cutting like crazy. But if it's an uptick from the threes where we are now to 5%, the Fed may be a little kind of, holding back in terms of cutting because they don't want to create that next wave of inflation like we saw in the 1970s. The other thing to keep in mind is why is rate cuts in a recessionary environment maybe not the best, is because it's actually, if you have a recession, it's actually telling us that stocks like Microsoft and Apple, people aren't going to be able to afford buying their products. The consumer is going to pull back, which means earnings start to drop, and obviously the forward-looking PE ratio for the S&P starts to get less and less, or in terms of too lofty a valuation. So to be honest, it's not necessarily a linear line with just all rate cuts are good. It has to be under what circumstances. So what the market was prepping for initially before CPI and PPI this week was we're going to have a perfect landing. There's no landing. The economy is going to stay strong, and the Fed is still going to cut rates. That's a great scenario for stocks, right? That's like the best of all worlds. But now it's getting a little bit trickier, and this is where things that have gotten into bubble territory may start coming in very, very quickly.
Well, what is going to drive inflation perhaps even higher, or just keep it at elevated levels above 3%, Gareth?
That's a great question. So I think if we started to see a really bad recession, then inflation does get down to the point where it could be deflationary. But if we go into kind of one of these stagnant markets where, for the most part, we're in a slight recession, it's kind of things are slow, things are kind of for a long period of time, where you're not really seeing a huge drawdown in the economy, where it's a deep recession, then I think you have the pressures of increases in wages that still get passed through. And we've seen that, by the way. I think the PPI is showing us that. The CPI is showing us that producers, they're paying so much extra. You have people that were making a minimum wage that are now making 2 to 3 times that minimum wage. That has to be passed on to the consumer to keep the earnings flowing from a lot of these big companies. And so it's not a one-year event, right? I mean, if you pay someone $20 instead of $10 an hour, you can't really just double the prices that you're charging your consumers. But what you do is you say, okay, well, I'll raise it by 33% this year, 33% the next year, and the next year as well to bring my profit margins back in alignment. So I think that's the kicker, is how bad is the recession and what do we see?
Let's summarize your economic outlook. Are you still projecting a recession to hit? Because we were making the assumption that a recession would cause deflation, if not disinflation. So is a
Yeah.
recession still happening based on
Yeah.
current economic data? Yes.
In fact, based on what we've seen recently, and I'm showing my S&P chart, I'm actually more confident that a recession is on the horizon. The retail sales this week alone showing a consumer that is slowing down much quicker than expected. You look at, again, credit card debt and all these other factors, including the government spending, right? I mean, government spending can lift us for a certain amount of time, but it's at some point there has to be handcuffs even put on that, where otherwise it's going to cause major issues down the line. So I am confident that we will see a recession. The question is it second half of this year, or is it before then? But I do think by the end of this year, we will see that recession. On the S&P 500, again, to see these type of runs, very, very unusual to see a run this vertical on the S&P 500. Again, if you look at the stocks in the NASDAQ, what's been leading? There's been a few stocks that have been carrying this market higher. Everything else is struggling, and that is also a concern. So again, then you look at China, you look at what their economy is doing, and obviously they're stimulating, but what are they going to export in terms of a slowdown to us? Because it is global. We are in a global environment at this point.
I just want to push back on the recession call. I saw
Sure.
somebody tweet this. I can't remember who. I can't find the tweet, but I remember seeing this and I thought, okay, this is an interesting argument. He said, all you have to do is go outside. I mean, go to a Taylor Swift concert or go to a restaurant. There's no recession, right?
Right.
How do you
Well,
respond to that?
as long as, yes, and that's fair. As long as you have people that have credit cards, you're right. But look at the savings rate. The savings rate was sky high during COVID. It has gone negative at this point. There's no doubt people are running out of money, but right now it's hard to change your living standards until the credit card companies cut you off. And they will do that once things get bad enough. And again, then look at retail sales just recently. Why weren't retail sales even better that were just reported earlier this week? So again, I agree. Taylor Swift is going to have fans, right? It's going to take a major recession for people to actually stop spending those, whatever they charge, like $500 pops or whatever. But ultimately start looking at the underbelly of the economy. There's still, I mean, and again, this is kicker too, right? You have basically two economies in this country and really in the world. You have the people that have been in the stock market that have been making money hand over fist, and those are a lot of the same people that are going to Taylor Swift concerts, and they're doing fine. But what about those other people? Because again, the middle class, just like
Yes.
before the Great Depression, it started to shrink more and more, and you had this huge divergence between the rich and the poor, and we
Yeah.
know how that ended.
Well, that's a good point. The wealth gap is increasing. We'll go back to the stock markets after this, but the wealth gap has been increasing. It has been doing that for quite some time, ever since COVID, really. Don't you think that the wealthy is just going to carry the rest of the economy? They're the ones spending.
Well, I mean, the interesting thing is we've actually seen the wealthy starting to pull back. I mean, a little funny anecdotal story here is that
Sure.
I bought, stupid me, thinking I'm a genius investor outside of the stock market and crypto. I went and I bought a couple horses, right? These show horses. Well, guess what? The sale market for these things literally dried up. As soon as interest rates started to pop and stuff, and I haven't been able to unload them. And the goal was to actually flip them. And now
Oh,
the rich are like staying away from buying horses, believe it or not, which is crazy. But to me, that's another signal. So again,
mm.
in real world situations, that's one good example that even the rich are starting to pull back. I don't know if it's political because they're worried about the coming election. Is it because of the economy? Is it because of other things? But there is a pullback in the rich spending as well.
Interesting. All right. Well, let's talk about the stock markets. If you pull back, if you put that the S&P 500 chart, Gareth, where you got the wedge pattern here. Um, look, I think the
Nice
first
job on
question.
nailing that term, by the way.
I've talked to you for years, Gareth. I've been learning a few things from you. I picked up a few terminologies here and there after a couple of years working with you, Gareth. But yes, this wedge pattern. Look, the first thing that people would ask you looking at this chart is how can you still be bearish looking at this chart? Right? I'll just leave you to respond to that.
Yeah, so number one is it's been a great uptrend. There's no doubt about it, folks. And I've been short a fair amount of this distance to the upside. But having said that, ultimately what we know is that when everyone else is euphoric, that's the time to be careful. Go ask Michael Burry in 07 and what he was doing when everyone was telling him he was a nut job. These are the times when you have to be more careful. And I think you also have to look at the data points, and that's what we've been talking about here. And for me, it's not a matter of if this collapses, it's a matter of when. Could we go a little bit higher? Certainly. If the liquidity in the system continues, if the economy continues to stay strong with people having jobs, yeah, we'll probably grind higher, but there will be a cliff dive at some point, a la what I showed on SMCI. There's only so far you can push things before they have these monstrous corrective moves. And again, I just want to show you a few stocks out there. Look at Hershey. Look at Hershey's. Look at the drop on this thing, where this thing is trading down here. I mean, you look at a lot of stocks out there, they have really come crashing back down. Here's WBA. What about this great, CVS, Walgreens? And there's obviously other factors going into these, but there's a lot of stocks that are very close to 52-week highs versus 52-week lows, 52-week lows versus 52-week highs. And things are continue to deteriorate on the internals. And that's why I stay with my call of a recession and a market that will come down hard at some point this year.
We have to remember the Fed hasn't cut rates yet. Once they do, Gareth, won't the stock markets just rip higher?
Well, actually, historically speaking, that's when the stock market actually drops. So again, I wish I had that chart preloaded to show you guys, but in reality, if you look at history, that's when the market actually declines. And the reason, this is great education, the reason why the market declines when the Fed starts cutting rates is the Fed is cutting rates because things have gotten very, very bad to the point that they have to cut rates. And the market gets fretful, meaning they start to worry that the Fed is behind the curve, that they tightened too much and they didn't start cutting early enough. So what they do is when the Fed says, oh, let's cut 25 basis points, the market says, oh my God, this is horrible, we're going to go into a crazy recession, they should have cut 50 or 75 basis points, and we actually roll over. And by the way, same thing for the yield curve inversion. We are still inverted on the yield curve, and technically we look at history and it shows us that when that yield curve uninverts, that's when the recession tends to hit.
Can we look at NVIDIA for a minute? I think this is a good masterclass where case study in technical analysis with fundamental analysis. So just from a pure technical standpoint, I think, look, it's gone up in a vertical line in the last 6 weeks. I think I know what you're going to say, but before I let you say what you're going to say, fundamentally, the stock is hot right now. The company's doing well. It's been beating earnings. Everyone needs their chips. The AI boom is still in full swing. People, not me, but analysts have argued it's still a good company. So how do you balance out possibly sound company fundamentals with a vertical line?
Right. So, and this is a great point. So this has been one of those narratives. It's a la Tesla in 2021. And I love you bringing up this point because it shows us how bubbles ultimately end. And you could say, oh, AI is not a bubble, but yeah, well, look at Cisco, look at Sun Microsystems back in 2000 when the dot-com bubble was. By the way, Cisco Systems has never gone back to the highs that it was trading in 2000 since then. Yet Cisco Systems was the hottest stock back then. It was the backbone of the internet. It was the only game in town, a la the AI chips from NVIDIA. And what ended up happening, right? Let's talk a little bit about this. What ends up happening is that all the other semiconductor companies, and by the way, there are hundreds of them out there, from Micron to Intel to AMD, they see the margins that NVIDIA is getting right now, 80% margins. And they're saying, holy crap, we want a piece of that. And so before you know it, just like with Tesla, all these companies start producing these AI chips, and the competition is going to crush margins, just like it has in the history for the semiconductors. And so ultimately what ends up happening is their margins collapse and NVIDIA will come crashing back down. Now, it doesn't mean it can't go to a 800 or a 900 or 1,000 first, but at some point it comes crashing down. And just to show us this, right? Let's go to Tesla. Let's go to Tesla during 2021 here and take a look. So we all remember this run. I mean, this is one of the most incredible runs because the EVs, the cars that Tesla were producing, they were the best in the business. They were the only ones that really people wanted. Yeah, you could get an EV from somewhere else, but it got like 50 miles to the charge. It was crappy, but Tesla was the best. What's happened? Every other car company out there is now coming out with fantastic miles that you can get per charge, great cars, and Tesla's cut prices over and over again, and their margins have collapsed. And here we see Tesla now. I mean, and you just look at the collapse that we saw here, right? If we take the high of 2021 to the low, it dropped 75% before getting this recent bounce. And again, markets, by the way, all-time highs. Tesla shouldn't even be in the Magnificent Seven anymore based on its performance, frankly.
Yeah, I was going to ask you about Tesla. Why it's been a laggard now on a technical basis. If you were to, this is one here, I'm going to throw out a counter argument. Tell me if it makes sense or not. So if you group Tesla in the Magnificent Seven stocks and you think to yourself, well, look, its peers in the large tech stock space are all doing well. So, comparable to its peers, it should also be doing well, but it's not. Therefore, undervalued, we should buy Tesla. Does that make sense to you?
It doesn't make sense yet. There's always going to be a price where something like as good a quality of company as Tesla is that it will make sense.
Okay.
For me, it's got to come in more before I mess with it. Again, think about this: the issues that they're having with China, right? We know China's economy is crushing them because China is hurting so bad right now. There's the risk of China. What if they invade Taiwan? And what do people do, or what restrictions are put on in sales in China right there? And then you have obviously the competition that's just continuing to put out EVs after EVs after EVs, which are quality ones now. So I would say for me, I have this trend line going back to the 2020 COVID lows right through this low in December of 2022. For me, that would be where I would start to think about it, around this $135 level. If it comes down there, which I think it will when the stock market corrects, I think that's where you start to get interested in Tesla at that point. But again, learn from these historic lessons about bubbles, folks. I really want to stress that to people because I want to show you just a few others. Do you guys remember the 3D printing bubble? There was a 3D printing bubble back in 2014. 3D was going to change the world, and it ran up 3D, DDD, this 3D systems ran up to 95 to $100. That collapsed down to $6, $93 drop. Remember solar when it came out in 2007? This stock, First Solar, unbelievable excitement over solar stocks. They all ran up. 73% drop. And so I do want to just impress people upon this, because don't look back and say, like with Bitcoin, with my call on Bitcoin at 69,000, it was going to go to 20,000. You have to start to recognize things that occur. Doesn't mean NVIDIA is not a great company, by the way. It's a fantastic company, but things get overhyped and reality eventually does set in.
Yeah, you're right there. But I mean, that was 08, 09. I mean, everything crashed. So
yeah, but I mean, even so, I mean, go out a little bit further. Here's 2012,
right.
markets were recovering, and it went to $13 on that. I mean, you can go as a dime a dozen of these type of situations. By the way, another one, I love pointing out this one. Remember how hot the marijuana stocks were? Marijuana stocks in like 2018 or so. Look at the runs up on Canopy growth, and then look at the collapse that these things had too. So I mean, again, everything goes through its hyped mode. As an investor, you have to be early in these things, or at least mid-level. Otherwise, in my opinion, there's too much risk to be buying something like NVIDIA after it's up X% this year alone.
Okay. Let's talk about Bitcoin. We can't ignore Bitcoin. I don't think you and I have spoken since the ETF launch. No, we haven't, because I was at a conference. And anyway,
do you remember my call? What I said was going to happen on the ETF launch? I said it would pull back and correct.
Yeah, you were right there. Yeah, it did.
Yeah.
But okay, so that's exactly what happened. But then something else happened in the last couple of days. So
Right.
what? It's now squarely above $50,000 a coin. A huge move. First of all, let's recap what happened, and then we'll give your outlook.
Sure. So we had the ETF launch, and that hype, again, hype is hype, whether it's in Bitcoin, whether it's in NVIDIA, whether it's in any of these things, it drives it to these crazy levels, overbought, and then you get kind of the sell the news event. And that's exactly what we saw in that. I happened to be short at that time. We got out just around this, just below 39,000 down here. And the beautiful thing about this is it created this, look at this channel. You have the highs here connected to these highs, and this low connected to these lows. And look at what we just hit on Bitcoin. So believe it or not, I initiated a new short just up here, very small position, just to kind of a dipping the toe in the water type thing. But again, the idea being is we'll see a pullback off of this. And now the recent run in Bitcoin, to me, it's not so much about the ETF anymore. That's out there. I think there's still a lot of hype about it. It's partially about the halving coming up, but it's also about money, right? It's about risk assets. When you see SMCI going up hundreds of percentage points in a couple of weeks, when you see NVIDIA doing what it's doing and the tech sector doing what it's doing, money is going to find other risk assets to participate. And I think that's what's driven up Bitcoin recently. Now, is there fundamental long-term reasons to be long Bitcoin? Absolutely. But again, my thesis is that if we see a 20, 30% correction in Bitcoin, in the stock market, which would be kind of run-of-your-mill after the NASDAQ's up, 60% since October of 2022, you then have to talk about Bitcoin possibly coming back to 30 to 32,000 on the charts.
Well, wait a minute. So same question as the S&P, right?
Right.
Just fundamentally, basically speaking, someone's looking at that chart and says to you, it's obvious we're in a bull rally, or it has been in a bull rally.
It
How
has
can
been.
you still be bearish? How would you respond to that?
Well, I think the kicker is this, right? Is that I'm a trader, so number one. So again, right here, I have a trend line. I short it. I buy support. If it comes down to the lower level, we'll buy support as well. But I think my point is this: is that when you look at the kind of the froth in the system, and
Right.
remember what I said earlier in this interview, folks. It's one of the biggest calls I'm known for of nailing the Bitcoin top at 69,000. Is that when I see social media behaving like it is behaving, it is exactly like that in stocks, not so much in crypto, but in stocks in particular, as those same indicators back then. And that is a warning sign of, the people saying, hey, you can just close your eyes and throw a dart at a dartboard and you'll get a winning stock and you'll make money. And that's a concern to me. So I do think we're kind of coming into a risk off environment. How big of a pullback? I don't know. But I do think on that, Bitcoin will just sell off just naturally as a risk asset.
Okay, so when there's a lot of hype, generally that's when things get frothy. Be prepared to sell. Can the reverse be applied? So I'll
Yep.
give you an example. Last year, you and I both attended the Bitcoin Miami conference.
Hmm.
Attendance was slow. I
Hmm.
think that may even be an understatement. It was a very quiet conference. Not a lot of people there. Not a lot of exhibitors there either compared to the previous year. When you look at a situation like that, do you think it's time to buy?
Yeah, absolutely, absolutely. Again, I wouldn't call it blood in the streets back then, but that's the idea, right? When there's blood in the streets, you buy. When the pizza guy is telling you the next stock tip, that's when you're supposed to sell, right? That's the old Wall Street adage, and it's very, very true. Is that you have fundamentally something like Bitcoin 21 million will only be in existence. So longer term, I think it performs really, really well. But again, for me, I look at shorter term time frames, and right now we're kind of in the frothy zone, mainly on the stock market. But I think with the stock market pulling back, Bitcoin likely would get a pullback here as well.
Do you think Bitcoin will reach its previous all-time high before a pullback?
I don't think so. I personally don't think so. I think that there's so much money that got burned in 2021 that unless this stock market continues up for another 10 to 20%, then probably we don't do that. And I don't think the stock market has another 10 to 20% before a bigger corrective move of at least 10% to the downside here. Now, again, I will be a buyer. Right now, my major line in the sand is that 30 to 32,000 level. So if we can retrace there, I'll start accumulating pretty heavily on the Bitcoin chart.
So any chance that we can have Bitcoin and stocks diverge? So let's say the stock's correct, Bitcoin keeps going up for.
Yes, there absolutely is a scenario. I think that's what's happening slowly, but again, it's something that until you get Bitcoin to really be accepted as a digital gold, it won't
Yeah.
fully diverge from stocks. But again, slowly, I mean, there are people out there, including myself, that are looking at it more and more like the digital gold. I just think that there's a lot of people in there that are trying to make easy money, and those are the people that have to kind of be flushed out first, and those will be the ones that kind of cause the selling when the selling does come in.
Bitcoin halving is happening in a couple months. Now, I just want to point something out, and I'll let you comment on this. Okay, so I don't know what's going to happen in the stock market or to the stock markets in a couple months. Who knows, right? But
Mhm.
let's assume the stock markets continue to grind higher before a correction, before a recession. Bitcoin, all else being equal, should also continue to grind a little bit higher along with the stock markets. People are going to say, well, it's because of the halving that the Bitcoin price is higher. Like, no, it's because markets are higher in general.
Right,
And so I'm just
right.
really curious to see what will happen to the Bitcoin price post happening if the stock market crashes. I'm just really curious to see what would happen.
Yeah, and I'm curious with you. I still think it'll sell off. Historically, you actually do see some selling pressure after the halving. It's almost like a
Okay.
hyped up thing, and then you see the kind of the relaxation. The halvings are really important, but it's more of a elongated type thing where that supply just gets cut less and less, and so as demand increases over the longer term, that's where price will generally continue to trend upside. But that doesn't mean that you're not going to get these blips where you see a 10-20% correction like we just saw following the spot ETF, and those will continue to happen in Bitcoin. I even think, again, if the stock market really gets in a risk off period, we'll get a bigger correction in Bitcoin, potentially down to that 30 to 32,000 level.
What are you bullish on these days?
Bullish. All right. Well, so you got to be bullish on gold and gold miners. And again, I'm sure people aren't super, super surprised to hear me say that. I do have some other stocks out there that I think are worthwhile, but I love the price action in gold here. It's so close to the all-time high line up here, which again, going back to 2020, that was that high line right across. We actually are up again today, consolidating beautifully. I would guess within a month or so, we are breaking out to the upside on gold. Gold miners are so cheap down here if gold can break out. I say if because again, if it doesn't, then gold miners aren't going anywhere. But I love the price action on the GDX today, getting a good move again. Beautiful double bottom right down here. Newmont Mining, AEM, Barrick Gold are all interesting plays. I'm generally sticking with best of breed right now because I think those will be the first ones to be the recipients, and then the juniors might be next. A couple stocks that I think are worthwhile keeping an eye on. I think something like Hershey. Hershey is, if you look at this, and I kind of highlighted this earlier as a stock that hasn't participated in the rally, but look, it's holding this breakout line. And one of the reasons why this stock's been under pressure is because of the chocolate price, right? If we go to this, I mean, look at this run on their main core commodity that they have to do. Look at this run up. It's an incredible chart, but it's starting to correct. And as price comes in, their margins, Hershey's margins should increase. And I think that's probably one of the great plays here going into the next couple months as a value play as well, and maybe a defensive play for a market correction.
Interesting. I mean, the Bloomberg Commodity Index is down overall this year, so a lot of companies using commodities as inputs would probably have the same narrative, right? Are you generally speaking bullish or bearish on the commodities?
Yeah, so I think it depends on which commodities, right? I love the chart on wheat. Wheat is continuing to consolidate. It actually broke below this trend. But I mean, at these levels, wheat is getting to points where we're talking about the COVID lows. You know, back when people thought the world was ending, that's where wheat was trading back then. And one of the kickers with commodities, something like wheat that people need to understand is that when wheat was at these highs, when these crazy highs up here, farmers overplanted. And that causes an oversupply, which then causes a crash in price. With price down here, farmers are cutting back on planting, which will just naturally, right? It's not worth their time. It's not worth their energy. They're not making money on it. But that by default will then push price back up when there's less supply out there. So, you know, again, it's not to say it can't go a little lower here, but we're getting to reasonable levels on these commodities where it does make sense to be long.
Are you concerned about oil breaking out to the upside? People are talking about the Red Sea crisis spiraling out of control, blocking supply lines. That hasn't happened yet, and oil hasn't skyrocketed yet, but could happen, right?
Yeah, I'm not hugely worried about a mega spike in oil because the U.S. is just such a behemoth in terms of
Yeah.
production. But having said that, we are at a major level of resistance here at around $79. If oil gets through 79, you're probably headed to about 85. And now you have to start talking about what does this mean for the CPI for next month, right? I mean,
Yeah.
so it's really watching oil is very, very important for the month-to-month CPI numbers. And then that can obviously put handcuffs more so on the Fed.
Excellent overview. I think I ran through every. Oh no, let's. I didn't touch the dollar. Let's close off on the DXY. I'm not letting you off the hook until we cover
No,
everything.
no problem.
No, but thanks for your time, Gareth. DXY. It follows interest rates quite closely, especially the Fed funds rate. The 2 year especially. So, given your read on the Federal Reserve, given what we've talked about, what's your read on the dollar?
So the dollar, based on what I'm seeing here, guys, is it just hit resistance in the last couple of days. Even with the PPI numbers coming in hot this morning, we are still seeing the dollar giving up all its gains and coming back down. So to me, this is resistance. I think we're actually going to see a fall on the dollar in the near term here. One trend line to watch on the Dixie, take a look at this one right here, right? Just connect this low to this low. If we take this low out, which is around 103.90, I think you could fall all the way back down to test this support at around 101. In general, I am a little bit on the bearish side on the US dollar. I also think that rates are getting to their maximum here, and I think we will start to see a kind of a curve over in rates as we start getting more and more weak economic data.
Right. Perfect. Where can we follow your work these days, Gareth? You're all over the place, but where should we go?
Just come to Verified Investing. We're just about to launch our new website. I'm just participating with many other investors and traders that are going to have services on there. So my service will be one of many services on there. I'm trying to kind of create this best of breed website with the most information that anyone could ever dream of in terms of economic data, charting data, education. And again, I love being the idea of me just being one of many on there that are great. So everyone can come. You can see track records. You can make decisions on who best fits you, and that's the way it should be. So thank you so much, David. It's honestly always I have a great time with you, man.
Yeah, it's a great start to my Friday afternoon. Good to see you again, Gareth. So I'm looking forward to this website. When is it launching? Do you know? Do you have an
We're
idea?
hoping by March 1st, but it's always a tricky one. We got to make sure it's working perfectly before we let it out.
Yeah, you sound like Elon Musk right now, but that's okay. Great. We can wait for a great thing. Thanks
As long as
very
my
much.
net worth goes in that direction, I'm happy.
Thanks very much for your time as always, Gareth. We'll see you again soon.
Thank you.
Thank you for watching. Don't forget to follow Gareth in the link down below. And don't forget to subscribe. We'll see you next time.